Looking for some fresh stock ideas that fly under the radar? Think the broader market's yield of less than 1.5% is too low? Does a 3.5%, 4.5%, or 5.5% yield sound interesting to you? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Dividend growth investing is a fantastic long-term investment strategy. It's a strategy that kind of automatically funnels investors right into some of the world's very best businesses. After all, it takes a special kind of business to consistently pump out ever higher profits and ever higher dividends year in and year out for decades on end. You can't just send out higher and higher dividends to your shareholders while simultaneously running a poor business for decades. It doesn't work like that. But as great as many high-quality dividend growth stocks are, they're well known. Of course, they're well known for good reason, because they're world-class enterprises that make for excellent long-term investments. Hard to keep a secret like that, right? But what if you're looking for some under-the-radar dividend growth stocks that don't get a lot of attention? And what if you're looking for a market-beating yield of 3.5%, 4.5%, or even 5.5% depending on your risk tolerance? I've got you covered. Today, I want to tell you about 3 under-the-radar dividend growth stocks offering market-beating yields. Ready? Let's dig in. The first under-the-radar dividend growth stock I want to tell you about is Flowers Foods Inc., stock ticker FLO. Flowers Foods is a consumer goods company with a market cap of $5 billion. This is a small bakery business owning brands like Dave's Killer Bread and Tasty Cake. A business can't get much easier to understand than this. You're primarily investing in bread here, which is a basic food staple. Despite the simplicity, consistency, and solid brands, the company is rarely talked about, and that arguably keeps the valuation low and the yield somewhat high. The stock yields a market-beating 3.5%. That's almost 3 times that of the S&P 500's lowly yield of 1.3% on a low-risk, easy-to-understand bakery business. Plus, this is a dividend that's been increased for 20 consecutive years with a 10-year dividend growth rate of 8.7%. And with the dividend only taking up about 64% of free cash flow, I suspect there's plenty more dividend increases to come. This stock is almost flat on the year, and the valuation looks very reasonable. Most basic valuation metrics are right in line with recent historical averages. For example, the 5-year average yield for the stock is 3.5%. That's where we're at right now. And the current price to cash flow ratio of 12.6 is very close to its own 5-year average of 12.8. This is an under-the-radar, easy-to-understand, low-risk dividend growth stock offering a 3.5% yield, pretty nice growth, and a reasonable valuation. Don't overlook it. Moving up the risk curve and the yield curve a bit, let's talk about International Business Machines Corp., stock ticker IBM. IBM is a global technology company with a market cap of $125 billion. IBM is not as obscure as Flowers Foods, I'll give you that, but IBM definitely gets overshadowed by a lot of other tech companies, and maybe that's for good reason. IBM has floundered a bit in recent years, but there's still a lot to like about the stock, not the least of which is its yield. IBM stock yields a very attractive 4.7%. We're talking almost 4 times the broader market's yield, and with 26 consecutive years of dividend raises and a 5-year dividend growth rate of 5.4%, it's not like the yield is all you've got. Now, growth has slowed of late, no doubt about it, but for income, you could do a lot worse than IBM, and this big dividend is easily covered by free cash flow. IBM has performed pretty decently this year, up about 13%, but the valuation remains rather compelling. Pretty much every basic valuation metric indicates undervaluation. The current yield is 20 basis points higher than its 5-year average. The lowly price to cash flow ratio of 7.1 is well below what almost every other tech stock commands. And it's also significantly lower than the stock's own 5-year average price to cash flow ratio of 8.0. On top of all of this, IBM has a new CEO, new growth plans, and an upcoming spinoff to get things moving in the right direction. Last but not least, let's move even higher up on risk and yield and talk about Iron Mountain Inc., stock ticker IRM. Iron Mountain is an information storage and management company with a market cap of $13 billion. Iron Mountain is actually a real estate investment trust, but it doesn't get nearly the same kind of attention that a lot of other REITs get. Now, their corporate name implies exactly what they've historically offered: extremely safe storage facilities for information. As information has gone increasingly digital, Iron Mountain has responded in exactly the way you'd wish for them to respond, by investing in data centers. Meanwhile, the stock offers an Iron Mountain of a dividend. The stock yields a market-smashing 5.4%. That's more than 4 times higher than the broader market's yield. Now, that yield comes with some drawbacks, namely higher risk and lower growth. Indeed, there are valid questions about how its investments in data centers will work out, as well as what kind of terminal decline some of its legacy assets face. However, you're getting compensated with a huge dividend in the meantime, and they've increased their dividend for 10 consecutive years with a 5-year dividend growth rate of 5.3%. And their funds from operations per share guidance for this year shows a payout ratio of slightly over 70%. High, but not dangerously so. This stock is up 60% year to date, so some investors have clearly caught on. Yeah, although I rarely hear anyone talk about this stock, it's obvious that some investors have been quietly accumulating their shares. Despite that, the stock doesn't look explicitly expensive. It's just that it's gone from extremely cheap to a valuation that is more in line with some other REITs out there. For example, its price to cash flow ratio is 14.2. Even after its big run this year, there's nothing extreme about that cash flow multiple. A lot of other REITs command cash flow multiples of over 20. I prefer to see a pullback here, as I'm sure all of you would as well, but if a pullback does come, take a good look at Iron Mountain. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these stocks. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.